All right, ladies and gentlemen, I hope you had a wonderful weekend. We got a very interesting week ahead with the non-farm payrolls, the minutes, the ISM, and then the holiday. So it is a short week filled with big jobs data, and on top of that, it is the summer, so we're going to go over all of that. But before I get into that, I want to talk about the huge trade that we made on Friday, turning $600 into $7,000. So why I want to talk about it, it was a great trade. If you guys were here on the watch list, I did cover it. We made two different sets right before the earnings. It was like 20 minutes ahead. I went very big on the Nike, and I want to share with you why. But if you watch the Monday, Tuesday watch list from last week, we also brought up the 85 contracts, and my goodness, those did even better. I think that play was about $60 into $1,200 alone. So it was absolutely massive, but now why I'm bringing it up, because it reminds me of the elephant in the room. So here's the deal. How do we do $600 in a $7,001 trade? It is the same strategy we have been doing for almost a year now. Believe it or not, it started with Nike and FedEx towards the end of last year. We started making a bunch of these big option trades, and I gave you that strategy, the quote-unquote ghetto standard deviation. I think it's how to price options. I've even included it in the description of every watch list this year. So go watch it. That explains why we go with the prices we go with, how to tell if it's going to be a decent play or not. And this was the strategy, but the real big thing with this play, though, it had to do with the why, and it has to do with the macroeconomic environment. I went big on Nike because we have been seeing a lot of subtle consumer declines all across the world, both in American names and Euro names. Specifically, the day of Nike earnings, if you were there live on stream, I kept talking about it from the morning till right when I made the play, and I said, hey, I'm just going to go with the writing on the wall, because we saw three other consumer-related European companies do awful. If you even look up in the last couple of weeks leading into it, every single consumer name has been struggling, and if they're not doing amazing, the fact of the matter is this story isn't good, and we are seeing a slight decline in a lot of these consumer stocks. Yes, inflation is coming down, but usually the cost of inflation coming down is consumer activity, and we are slowly starting to see it. So that's why I went with the Nike play. But if you also think about it too, we hit the FedEx this week as well, or last week, but there's a whole nother element going on. I want you to think about consumers slowing down or holding up, but now the next big question you got to be looking for if you want to replicate this type of play, is that company going through a recovery? This whole recovery story is a big deal. Any company in the last year or so that's had a big drop or a big pop based on a new full-year plan going and giving guidance, and then they drop the ball, then they did good, or they keep dropping the ball, that's the story of Nike. That's the story of FedEx. You could even go look at companies like Snowflake and Palo Alto and think about all the big earnings moves. It's either they're already in a league of their own, or they are going through this recovery story. So if you want to find a lot of these plays moving forward, I would pay attention to the ones that are going through this or not, either confirming after a couple of quarters or they're just starting to fail. I think these are going to have the biggest moves of the season. So watch that standard deviation, the ghetto standard deviation video. Keep your eye out for these names, and if you start seeing trends all around the world, man, maybe it might be worth it taking the risk, but always keep it small. This play just worked out very good. Again, I was able to hold one of them for free, but it was about like $600, like $660 turned into over $7,000 realized. So that was awesome. We'll talk about everything else and all of that, but Chattadonia, now let's talk about the day, the week, what we're getting into, what I need from you. A thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/The Stock Market. We will see you there in the morning, baby. Run it.
Couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
And I almost forgot, before we get into the keys and all of that, Today is Sunday. Tomorrow is Monday. This is the random account. So what we have done with this account, we started with only a couple $100, and what we ask is every week on this watch list, you post a random option trade, keep it below $100, preferably with time, no spreads, no anything like that, just a straight up call or a put. We're going to do a random comment generator tomorrow morning before the bell, and we are going to buy it. So I think we forgot last week, but Chatadonia, let's get a good one. But now let's also talk about what we're going through. So I guess we'll start even here with the chart. Friday was a really interesting day, but what I want you to notice, we spent all of last week going absolutely nowhere, and ironically enough, that going nowhere level was the peak of Powell not too long ago. It was both CPI data, and then you had Powell, and now that's why the non-farms this week is going to be important. But think about it. You had that huge expiration the week before that, and then you did not move at all. We had a lot of back and forth. Believe it or not, we did actually hit a new high, so that was good. But that end of the day there, we saw a really weird move with the market breadth, and I'm not trying to give you anything to look at, but the point is, one of the themes from last week, you are watching either 7 names lead and then the other 497 do bad, or the 497 and the equal weight do good and the 7 do bad. But it's like we have gotten a lot of movement on a lot of different names, but the indexes aren't moving because of that concentration. So we'll talk a little bit more about that. But now getting into the week here, it's going to be a pretty weird week because you have the holiday and then you have big data. So usually like people take off and then it's going to be slow. I might even take off early. I'll let you know if I do, but it's going to be kind of weird in that sense. The volume's already low because of the summer, and now you're going to have the holiday. That is going to be on Thursday. The market will be closed for 4th of July, but then literally the next day, you're going to get non-farm payrolls, and then leading into that, you're going to get the JOLTS jobs opening, the ISM, and all these other data sets that have the ability to move us. So it's going to be weird there, and there's also going to be a little bit of that earnings hangover. We got FedEx and Nike last week, but here's the deal. You don't have any companies this week. It's not like there's anything big on the schedule, so you're going to have some of that anticipation, but I hope you got a little bit of patience. And then the cherry on top of all of this, the international part is a huge deal right now. The international macro, what's going on with France, their bonds, what's happening with these Asian currencies, the yen, the yuan, even China's recovery. This is a big deal. So we're going to hear about some of the French election stuff here tonight, but you got to keep in mind when stuff is happening all around the world, why I'm saying it's a big deal, because it's making the dollar a wrecking ball, and the dollar keeps getting stronger as the rest of these currencies get weaker. And now, depending on the data in summer, that would be something to watch out for, because if the dollar makes a big move and the market doesn't react, I think by the end of summer, maybe the chickens will come home to roost if the dollar really is that wrecking ball. So watch out for that. That is the first key. The second key, just get familiar with the events that we're having this week. ISM, you are going to be getting the Fed minutes. So remember, you did get a downgrade on the dot plot at the last FOMC, so these minutes might be a little bit more important, especially with the Zaza and the rate cut odds holding where they are. It'll be something to watch for. And then job openings, NFP, so far all the data has been favorable. Again, even inflation coming down. What I would be watching for with the jobs data, just like the consumer, if we start seeing it slow down, that may be a sign there, and the writing may be on the wall. But some people have been asking me a lot. They're like, well, okay, the consumer's slowing down. Is this from the jobs? Is this from the jobs? And it's no, not at all, actually. Believe it or not, the jobs are doing good right now. And even though the consumer is slowing down, and we have evidence of that in a lot of different places, the jobs and the job market, the strength or weakness, that is going to add fuel to the flame or not. It's not as if that is what's causing this. So So a lot of people ask me that. I hope that helps out. And then the final thing is, you're going to have a lot of Fed speakers today, or not today, just throughout the week. And then there's just all these events, but the weird volatility or the weird lack of volume with a holiday, I think that's going to be the weirdest part. So watch out for that. And then coming into the final key, man, it's peak summer, so there's still a lot in terms of what could happen policy-wise. Believe it or not, people think the first cut right now, the odds are on September. That will be the end of summer. You just saw these last couple weeks. Yeah, we're hitting highs. We're making all these different moves, but it's not like you're getting real big movement. We got a nice earnings play, and that was great, but at the same time now, until we get a lot more data or really blowout earnings, we are probably not going to be doing much here for summer. And why I'm telling you this, because I've been saying here a lot, like, yo, if the environment here, if you do good in it, and, small movements or small data causing these really wicked moves, and then you got to wait on certain things. Some people thrive in this environment. Some people, this might be your opportunity to sell a lot of premium. But if not, you could see, we've been playing 2K during some of these days, doing a lot of stuff, but I wouldn't stress yourself out trying to chase certain things in this market until that golden path starts getting to a point where it's either we have to board or disembark. Is that the word? Yeah. So watch out for that. And then finally, I've said it a lot this video, that consumer play, it's something to watch out for. And let's see if we get a new narrative following all of these earnings. So you still got about 2 or 3 weeks here. It is the end of June. We'll see where July takes us. But now, let us get into the plays. So, right off the bat, the plays are kind of simple, and I got to start with here, Nike and FedEx. I still have that 300 call from earnings. It's up like 300-400%. I want to ride it out because I think 313, that'll be the peak there on FedEx. And then Nike, I got one more free contract worth about $500. I think we spent like 29 cents on it, so still a good amount there. We'll see. And then I did add Nike to the long term. I grabbed 50 shares on the big account at like 76.50, then 5 shares on the YouTube account, and then I only got like 2 on Cold Sister, or 1. I don't think she made her deposit. Yeah, I know, but these plays, they should be big. And Nike, everyone's asking, like, what do I think is going to happen? I think it could go lower, even though I added it to the long term. Fact of the matter is, we are getting another deposit, so I figured, hey, let's start off. I didn't want it to be like Starbucks where it flushes down and then I never get an opportunity, because believe it or not, this was the worst day for Nike since it debuted in the 80s. So this was the worst day for Nike in history, of its history. So pretty wild to think about, but I figured, hey, I'll grab a little bit. But you've seen this thing drop, and it might stay pinned for 5 days, then have a flush out, and then kind of like chill out. That's what I'm expecting, or pretty much it could go a little lower, or it's going to stay pinned for a couple days. But the key is a couple of days. Give it a couple days to work everything out, and then I think we're going to see whether or not people are buying the dip, or if all the downgrades and negativity, if that's really going to be hitting it. And then if we want to keep adding more, we can. So watch out for that. I think those will be 2 big continuations this week. And then play number 2, I still have a free one from last week, and then I made a play on this on Friday, but Chewy. It's the Roaring Kitty Gamble, and what I mean by that, it's stupid. He literally just posted a picture of a dog, and this thing went crazy. Now, here's the deal. This is what I want you to look for. You don't hear me say this a lot either, too. This is the wild part, but I'd keep an eye on these short-term Chewy options. If you notice any big plays, any big option flow coming in, it's like the GameStop one, but you saw that effect. I think I don't put it past Kitty to, if you find some of these plays, go in big on these short terms, make his little tweet, and then it goes crazy. Again, I made a lot of money on the first one, and then even on Friday, I did make a play on this, and the crazy part, stock went down, those plays went up 30%. I still made money, and then it eventually stock bounced up, but the premiums are wicked. So if you notice a lot of decay and you notice a big option trade come through, I would definitely keep those ears perked up for that. So watch out for that. That is play number 2. And then finally, this one may be a little bit weird, but Visa and MasterCard. There's been a lot of updates from last week on this little swipe fee settlement, and they got a lot of things going on policy-wise. I don't know, is MasterCard, are they still trying to buy Discover? But there's a lot going on in terms of news, headlines, and then it's a financial. They have been leading all this year. These credit card companies, again, we hit like AXP and MasterCard too on some of the earnings at the beginning of the year. They're going through a lot, and now they're kind of selling off. I just keep an eye on them, especially if it is quiet this week and they get a lot of the headlines. This could be a play in its own little world. So those are the main plays. As far as everything else I did on Friday, I closed 19 to 20 of those Nike puts. I got one remaining. I closed that 85 one that we did. It was on the Monday, Tuesday watch list. Yalla. I grabbed a ZB for a flip and got murdered on it. That one was wild, so I'm in a bond play. I only wanted to day trade it, but I was like, I didn't think it would get that bad, and I think there'll be a pop, but that one could be risky here. We'll see how that plays. And then I got rid of the Chewy flip. I still have one of them. I think the one I flipped, it was like a next week 32.50, and I grabbed them at like 60 cents. And then I sold out at like 70 something. They went up to 80, even though the stock went down. And then that CCL call, if you remember, we put that on the watch list too. Got out of that with like 225%. That was an earnings continuation play. So those were the main plays. As far as everything else, we already went over the question. And now Let's get to the lesson. It's time to end the ISI lesson, actually part 1, and then we're going to move into part 2 that mentions neoliberalism. Oh, I said that weird. And then industrialization. But like I've been telling you, man, good work. We've made a lot of progress. I think some of you have even seen, again, it's kind of crazy how we're getting into so much macro stuff in the world, this French stuff, the dollar, all of that. And now we're making good progress because these next couple chapters afterwards, you're really going to start learning some more economic stuff that I think you can find a way to apply to the macro. So let's get into it. If I ever interrupt, that is my opinion. So don't let my bias get to you. I try to keep it unbiased. And that's why this book here, it's International Political Economy, that's the title, by Thomas Oatley. I like it because it always covers both sides, so it doesn't really show its bias in that sense. I think some of you have enjoyed it so far, and if you don't know, we have a playlist. If you like this economic stuff, bro, I've been adding them to all of these watch lists, and there's a playlist on this channel, The Trading Fraternity, and we are going through this textbook and getting a lot done, baby. Welcome to class, but now let us get into the lesson, reforming the international trade system. Developing countries also try to alter the rules of governing international trade. For many developing country governments, these efforts reflected their experience with colonialism. India's perspective was not unique. International trade was a whirlpool of economic imperialism rather than a positive instrument for achieving economic growth. Consequently, as early as 1947, India, Brazil, and Chile were arguing that the multilateral rules of the United States and Great Britain were writing failed to address the economic problems that developing countries faced. Advancing the infant industry justification for protection, many developing countries argued that their firms could not compete with established products in the United States and Europe. Yet GATT rules not only made the provision for the infant industry justification for protection, but indeed explicitly prohibited the use of quantitative restrictions and tightly restricted the use of tariffs. Developing countries insisted that they be given a relatively free hand in the use of trade restrictions to promote economic development because the GATT failed to do so. Developing countries continued to press the GATT for reforms throughout the 1950s. By the early 1960s, a coalition of developing countries dedicated to far-reaching reform had emerged. Its first important success was achieving the formation of the United Nations Conference on Trade and Development, UNCTAD, of March of 1964. The UNCTAD was established as a body dedicated to promoting the interest of developing countries in the world trade system. At the conclusion of the first UNCTAD conference, 77 developing country governments signed a joint declaration calling for the reform of the international trade system. Thus was born the Group of 77, the leading force in the campaign for systematic reform. During the next 20 years, trade relations between developing world and the advanced industrialized countries revolved almost wholly around competing conceptions of international trade rules embodied in the GATT and UNCTAD. So, if you guys aren't remembering, and hopefully you're seeing the broader theme at play here, it has to do with some of these a lot of these developing nations. How did they develop to where they are now? In the early days, it was rough. You had, again, just a bunch of landowners. They had to switch the economies. Even if they got that done, they had to compete with the Europes and Americas of the world. And then if you got under this system and agreed to do this, then you couldn't protect your industry. And it left them in a very bad spot. And that's why, like, they all got together and they started advocating for more reforms, because even if they followed the same rules as some of the developed nations, they weren't in the same spot, and they had a lot to go through. If you think about it, that agriculture stuff and switching to the industrialization and then now competing on the big scale, you could see how this was a challenge that, again, from the 1950s till today, that's what kind of got us into this globalized world that we're in now. So continuing. During the 1960s, the Group of 77 used UNCTAD to pursue 3 international mechanisms that would increase their share of the gains from trade. First, the Group of 77 sought commodity price stabilization schemes. Commodity price stabilization was to be achieved by setting a floor below which commodity prices would not be allowed to fall, and by creating a finance mechanism funded largely by the advanced industrialized countries to purchase commodities when prices fell below the floor. Stabilizing commodity prices would be an important step towards stabilizing developing country terms of trade. Recall the Singer-Prebisch theory. The Group of 77 also sought direct financial transfers from the advanced industrial countries to compensate them for the purchasing power they were losing from declining terms of trade. Developing countries also sought greater access to core country markets, pressuring the advanced industrialized countries to eliminate trade barriers on primary commodities and to provide manufacturing exports for developing countries with preferential access to the core country markets. So simply they said, give us a floor on commodity prices, and anytime we're losing out and you guys are taking some of our money, compensate us, and then let us maximize our core country markets and get rid of any trade barriers. Let us sell to you and let us even protect our own. So moving forward, these reform efforts yielded few concrete results. Core countries agreed to incorporate concerns specific to the developing countries in the GATT Charter. In 1964, 3 articles focusing on developing countries were included in the GATT Part 4. Part 4 called upon core countries to improve market access for commodity exports, to refrain from raising barriers to the import of products of special interest to the developing world, and to engage in joint action to promote trade and development. In the absence of meaningful changes in the trade policies persuaded by the advanced industrialized countries, however, Part 4 provided few concrete gains. The advanced industrialized countries also allowed the developing countries to opt out of strict reciprocity during GATT tariff negotiations. The developing countries that belonged to the GATT were therefore able to benefit from tariff reductions without having to offer concessions in return. Benefits from this concession were more apparent than real, however. GATT negotiations focused primarily on manufactured goods produced by the advanced industrialized countries and excluded agriculture, textiles, and many of the other labor-intensive goods. Developing countries were therefore exporting few of the goods on which the advanced industrialized countries were actually reducing tariffs. In the late 1960s, the advanced industrialized countries agreed to the Generalized System of Preferences, the GSP, under which manufactured products or exports of developing countries gain preferential access to advanced industrialized countries' markets. This concession, too, was one of the limited importance because advanced industrialized countries often limited the quantity of goods that could enter under preferential tariff rates and excluded some manufacturing sector from the arrangements entirely. Even though their efforts during the 60s had achieved few concrete gains, the Group of 77 escalated their demands in the early 70s. Escalated demands were sparked by the 1973 oil shock. The oil shock was a clear illustration of the potential for commodity power. The world's major oil-producing countries, working together within the Organization of Petroleum Exporting Countries, OPEC, used their control of oil to improve their terms of trade. OPEC's ability to use commodity power to extract income from the core countries strengthened the belief that the Group of 77 that commodity power could be exploited to force fundamental systemic change. Greater confidence of the possibilities that their control of commodities offered led the Group of 77 to develop a set of radical demands dubbed the New International Economic Order, NIEO. The NIEO represented an attempt to create an international trade system whose operations would promote development. The NIEO, which the UN General Assembly adopted in December 74, embodied a set of reforms that would have radically altered the operation of the international economy. In addition to the 3 mechanisms that the developing countries demanded during the 60s, the NIEO included rules that would grant developing countries greater control over multinational corporations operating in their countries, easier and cheaper access to northern technology, a reduction in foreign debt, increased foreign aid flow, and a larger role in the decision-making process of the World Bank and the International Monetary Fund. Governments in the advanced industrialized countries refused to make significant concessions, and by the mid-80s, the NIEO had disappeared from the international agenda. The failure of the NIEO has been attributed to a number of factors. First, developing countries were unable to establish and maintain a cohesive coalition. The heterogeneity of developing countries and interests made it relatively easy for the advanced industrialized countries to divide the Group of 77 by offering limited concessions to a small number of governments in exchange for defection from the broader group. In addition, the Group of 77 had hoped that OPEC would assist in the linking access to oil and the acceptance of the NIEO, but OPEC governments were unwilling to use their oil power to help other developing countries achieve broader trade and development objectives. More importantly, however, in the early 1980s, many developing countries were facing serious balance of payments problems and turning to the IMF and the World Bank for financial support. The need to obtain IMF and World Bank assistance altered the balance of power in favor of the advanced industrialized countries. This power shift sparked a reform process that fundamentally changed the development strategies throughout the developing world. So, with all of that, think about it. After the oil shock, they're like, wow, we got power with these commodities. Let's come together and do this. But it ended up not working. But let me ask you this. What does that sound like? Some of you loved it. What does that sound like? You tell me. But now, conclusion of the chapter. Throughout much of the post-war period, developing countries insulated themselves from the world trade system. The interaction between domestic politics on the one hand and economic shocks and decolonization on the other generated governments that were highly responsive to the interest of import-competing manufacturing industries and a growing class of urban workers. Influenced greatly by structuralism, most governments transformed their political incentives to protect those domestic industries into ambitious state-led development strategies. Structuralism's critique of the ability of domestic and international markets to promote industrialization led governments to intervene in domestic markets to overcome the market imperfections that reduce private incentives to invest in manufacturing activities. To the extent the developing countries participated in the global trade system, they sought to achieve far-reaching reform of the rules governing the system. Again, the structuralist critique served as an important role in the effort, as it suggested that developing countries could not expect to gain from trade. Remember, that was that belief they all had with the advanced industrialized countries until they themselves had industrialized. Moreover, structuralism claimed that the trade based on GATT rules would only make industrialization harder to achieve rather than accept participation in the global economy on what they viewed as vastly unequal terms. Developing countries battled to change the rules governing international trade in order to capture a larger share of available gains. Thus, an international struggle over the distribution of the gains from trade arose as an important counterpart of the domestic strategy of redistributing resources from agriculture to industry embodied in ISI. So here are the key terms. Hopefully it's making some sense. It's understanding this chapter, the struggle, the belief, why they believed it, the theories, again, the structuralism, what ISI was and how it's developed, and now kind of getting you an idea of why these changes occurred and literally leading up until this day and where they all fared. So we're going to get into chapter 2. It's going to discuss a little bit more, and we'll see, as you know, again, from the 70s and 80s, what other ideas did they come up with. But Chad, that is all I have for you. I hope you're ready to start off the week, but that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember your goal. One of the purposes you have here on this earth, baby, it is to provide. So make sure you make an effort, Chadadonia. But I love you. Drink that water. Stay hydrated, healthy, all that good stuff. I'll see you in the AM and horn.